Ladies, gentlemen, we are now to welcome to this round table Mr. Vincent Girard, Head of Project Finance of the European Investment Bank in the Iberian Peninsula and Adriatic Sea countries, and Mr. Henrik RABER, Global Head of Capital Markets of the Standard Chartered Bank. Would you please, dear Vincent, dear Henrik, briefly introduce yourself and the institution you work for?
Thank you, Aurore. Thank you very much first for moderating this panel. Dear Henrik, that's a pleasure to be with you and talking this afternoon. And it's an honor to be with all of you in this Infra Week inaugural day, key conference for the industry. So my name is Vincent Girard, working at the IB for 15 years and covering financing of infrastructure, mostly within the European Union, from digital infrastructures, transport and energy. I've covered for a number of years also projects in Africa. A quick word on the EIB. EIB is established in 1958. It's a bank owned by the member state of the European Union. We've lent around €1 trillion since inception. And our strategy focuses on 8 core priorities, which are set by our new president, Nadia Calvino, which are climate action, digitalization and technology, security and defense, key, modern cohesion policy within Europe, agricultural and bioeconomy, social infrastructure, and high-impact global investment. And last but not least, we support also the capital markets union that we've discussed briefly this morning. That's it.
Thank you, Vincent. My name is Henrik RABER. I head the banking business at Standard Chartered Bank. We're an international bank over 150 years old. Historically, been very focused on Africa, Middle East, and Asia. We're present in about 60 countries. And as an emerging markets bank, we've been historically very focused on the infrastructure space. So delighted to be in Paris, which is increasingly the European hub of infrastructure, and look forward to the conversation.
Thank you. Emerging markets are strategic markets for the worldwide decarbonization railroad. They are often most susceptible to the effects of climate change and face the largest gaps in financing for both adaptation and transition. If emerging markets continue with their existing climate policy and transition investment, we are likely to see catastrophic global temperature increases of at least 3 degrees by 2100, perhaps even as high as 3.5 or 3.6, attracting the necessary capital from developed markets to aid emerging markets transition is a challenge. In addition, a fairer transition financing model with the public and private sector working together is a necessity to plug the financing gap. Governments and private sector investors will need to take a market-by-market approach, recognizing that each market has its own emission reduction pathway and challenges to transition at pace. Dear Henrik, what are the key trends you see evolving across infrastructure financing?
Thank you. Well, I think there are a range of trends developing, and interestingly, infrastructure has probably become one of the most exciting areas of finance. That didn't historically used to be the case. So I think there are 3 or 4 key trends which also are impacting emerging market. Firstly, infrastructure has become very global. So we're now looking and discussing infrastructure in pretty much every continent and every single country, and how the demand for infrastructure is needed and the expansion on the investment spend is needed. What used to be discussed in project sizes of 100 to 200 million are now 1 to 10 billion transaction sizes, and the overall need, particularly for climate, means that we're into the trillions in terms of the capital required. I think secondly is also the need for capital efficiency. Across the banks, the private sector, and the development agencies, there's a much stronger focus around the capital efficiency requirements, whether that's been driven by banks through regulations or the fact that the scale of the projects means that more capital is needed. Many of our colleagues in the development agency also need to materially leverage up the capital they have. So the sheer scale of the project combined with capital efficiency, I think, is a really interesting debate and a problem that needs to be solved globally. Specifically in emerging markets, over the last year and a couple of years, we've seen a couple of shocks. We had an interest rate shock and we had a very strong US dollar. So unfortunately, infrastructure is materially lower in terms of investment. Year over year, infrastructure finance is down 50% in Asia, but I think that's going to return as the interest rate market starts to normalize. And then lastly, of course, is renewables. Renewables is incredibly important. If you look at India, it has some of the most efficient renewables through solar. And I think in other parts, for example, the Middle East, they'll have incredibly low cost of energy supply through the new renewables space. So renewables now is about 25% of the spend in Asia infrastructure. We think that's probably going to rise materially over the coming years, but that's going to be a theme that you very much see across all the global markets.
Thank you. Dear Vincent, the European Investment Bank Group supports the economic, social and environmental objective of the European Union by providing a wide range of financial products and services. Would you please explain the strategy of the bank regarding the financing of decarbonization in emerging markets? Which emerging markets are involved and what are the financing levers of the bank regarding the financing?
Yes, thank you. First of all, it's important to clarify, European Investment Bank is working a lot in Europe, as it says, but it's also active outside the Union, no? And while the activity outside the Union represents roughly 10 to 15% of our global activity, it represents, in absolute terms, 8 to 10 billion euros of financing per year. So it's an important part. We are working together with the Commission, and I would say we are the financing arm of the Commission when working in emerging markets. Concretely, what does it mean? We work with partners pretty much all around the world, including in the Western Balkans, in Middle East, Sub-Saharan Africa, Latin America, Caribbean, Asia and Pacific. Important to say as well that most of our operations are backed by the NDC Global Europe mandate, which is a main financing tool to promote sustainable development from the Commission. No? So I was saying last year we've lent 8.5 billion euros, 25% in Sub-Saharan Africa, another 20% in the Western Balkans and Turkey, and 25% in Latin America, and 25% in North Africa and the Middle East. A few examples. Interconnector between Peru and Ecuador, 100 million euro loan from the EIB. Metro project in Agra Kanpur in India, another 500 million euros. So these are big tickets. These are billion projects, multi-billion projects. Some water project in Northern and Sub-Saharan Africa. Then, what's important to highlight is that the way EIB work and finance infrastructure in those countries is through a wide range of products. It can be through loan to the public sector, sometimes it's very useful, but also loans and guarantee to private companies, equity in fund investments, sometimes microfinance also and SMEs. So it's a very global approach of the need of those countries. And of course, when it comes to PPPs, a lot has to do with project financing and PPPs. That's where I come from and that's what I'm doing most. And sometimes we're also providing some blending activities. It means that we provide technical assistance, sometimes some grants, and that's pretty much what we are doing in those countries.
And when financing decarbonization in emerging markets, which criteria does the investment bank apply?
That's a very good question. Thank you very much for that. Because we labeled ourselves the climate bank. With 2019 has been a key year for us. We've adopted our new energy lending policy, and following on the COP from Paris in 2015, we've developed what we call the climate bank roadmap. Okay, so this is the policy we are applying across all the projects we are financing, both within the EU and outside the EU. And so, for example, talking about the energy lending policy, it's to inform our shareholders, stakeholders, our borrowers and promoters, but the civil society at large. What type of energy project we support? We cannot do everything. We have phased out a lot of sectors. How we assess those projects on a comparable basis, and how we prioritize. Okay. and this has been done with in close collaboration with the Commission. And together with that, we have adopted what we call the climate bank roadmap. So it's basically a new set of ambitious targets for climate action and environmental sustainability. Based on we've pledged to provide, we are talking about billions, but in that case, it's 1 trillion of investment over the decade 2020 to 2030. We are pledged also to increase the share of our financing dedicated to climate action and environmental sustainability. We already exceed 50% of EIB financing towards climate action project. And then, but last but not least, we've decided to be Paris aligned. So Paris aligned, what does this mean? We've set a set of series of criteria, not only to finance the best project, but also to ensure that behind those projects, we have companies that are that really do some efforts to decarbonize their activity, and in some cases we had stopped relationship with big companies, even though they were promoting some good project, because we saw the effort they were putting on their decarbonization path was not sufficient. So basically, that's the criteria that we are applying across all our activities.
Thank you, Vincent. And Henrik, given the huge infrastructure needs of emerging countries, besides conventional sources of capital, do you envision government sponsors also tapping into new liquidity pools in the foreseeable future to meet these requirements?
I think that's one of the most topical questions currently when it comes to infrastructure or sustainable finance. And that's going to mean that many parties are going to need to come together to build sufficient scale or leverage in the capital stack in order to execute the transactions. And I think it's also, when you look at infrastructure specifically or renewables, that sometimes you're many times dealing with new technologies. And when you're dealing with new technologies, the risk appetite around those could be very different from, for example, or infrastructure that's already produced or built. Even in the construction phase today, sometimes it's difficult to bring private capital in outside of the banks in terms of getting a transaction built. Many times we see the private sector, particularly funds or sponsors, come in once the asset's actually producing a cash flow. So I think it's going to be critical to bring all forms of capital together. And I think the work that's going on, particularly between the private and public sector, is as close as it's ever been and continues to get even closer. I think if you see from the back of the meetings in annual World Bank meetings the last 2 weeks, there's strong enthusiasm for the development agencies to work with the banks or sponsors to drive projects forward, and risk share transactions is probably as close as it's ever been. We've also seen insurance companies willing to increasingly give protection around construction period or assets. If you can make an asset more investable, we're going to bring in a lot more investors into the space. And I think lastly, which is obviously very topical, has been private credit or private funds who very much are focused on the infrastructure space. They're focused on it because it provides long-term, high IRR transactions, and particularly for the insurance company space. If you can deliver long-term, high-yielding assets, that is a great asset for insurance companies. So trying to leverage all of these together through various partnerships, I think is going to be the solution to the needs that are required. And I think the needs are only getting larger because the infrastructure space, which historically might have been quite defined as roads or ports or energy, has expanded now to include data as well. Obviously, data centers, the expenditure there, or the digital, these asset classes are not only going to consume power, but they're going to consume a lot of capital. So bringing people together around this, I think, is very, very exciting. We're probably as close as we've ever been to having true partnerships. And the experience overall on many of these projects has been quite good. I think through COVID, there was some challenges around the supply chain, which we particularly saw, for example, in emerging markets around delivering some of the renewables, whether it be wind or solar. Hopefully we're through that period. And I think the long-term capital that's now interested in infrastructure is absolutely phenomenal.
Thank you. And would you like to add a few words regarding specific regional markets, Henrik?
So I think in our footprint, Asia has seen a lot of activity, but each market is slightly different. So Australia is obviously a very developed market, which has always historically seen a lot of infrastructure in it. If you look in ASEAN, we've had Vietnam, very busy in the renewable space, whether that be wind or solar. We've also, for example, now seen data centers starting appearing on scale in Singapore or Malaysia. So across our footprint is very, very busy. Africa continues to have good funding and financing for roads, ports, desalination, hospitals, but there is a chance that on the return basis, people are starting to find different levels of opportunity. And of course, there's been an explosion of activity around some of the other markets, and in particular, one market that's been very busy has been the Middle East, whether that be pipeline transactions, infrastructure around wind or power. There's a lot of activity around this. So I think just by the number of people who are coming to today's conference, it should give us a lot of enthusiasm around the future in this asset class is going to be very exciting.
Vincent, would you like to add something?
Maybe not on specific market, but say a few words about what we call the Global Gateway Program, which is not working with one country, but is working to connect several countries amongst others together and better working together. The connection amongst countries is something that the European Commission wants to promote through this program in order to make sure those key infrastructure, connected infrastructure at regional level are not only financed by one big country with specific interest in the country. So what does this mean? It's connecting countries through transport infrastructure, but it can be railways, but it can be road as well. I have in mind this 300 kilometers road near the Cameroon border to unlock Chad access to business. But it happens also in close to Europe with a huge rail project, €500 million to connect Serbia and make the people and the cargo reach Hungary and Greece. So this is working at regional level so that people can work better together.
Thank you. Do we have enough time for a question or maybe? Yes. Okay. So. Do we have a question?
Yes, hi. So I'm from northern Chile, from Atacama, and I specialize in the development of green hydrogen projects over there. And we see two types of projects. So basically the island mode projects or standalone projects, which they have vertically integrated infrastructure, usually conducted by one specific big company or consortium of companies. And then we have a second type of infrastructure, which is on a hub level. So common infrastructure or shared infrastructure, which is more of like a public policy-driven infrastructure which will benefit the whole hub. So the first one usually we see is getting financing in the short term compared to the second one, which is more complex. So how do you see the difference between these two types of infrastructure assets, and how do you approach when it's cluster level and when it's vertically integrated in one specific project? What are the specificities when you evaluate both of them?
From a bank perspective, we evaluate each project on its own and sort of the bankability of the project. Many of the transactions, as you mentioned, they tend to have a strong sponsor behind it, which gives comfort around the credit quality, around the ability to distribute the asset, hedge the asset. I think the model you talk about moving to a hub is very beneficial, but you probably get into some complexity about the legal ownership, who has the decision right, and so forth. So if you can iron out that type of issue and create hubs or solutions around scaling infrastructure, I think it would be very beneficial. But from our perspective in our Asian markets, we haven't seen that ability to take off yet. It's been more driven by a specific project, specific government, or specific sponsor, where the attractiveness of the asset makes it viable. I don't know, on a development bank basis, is it difficult to maybe sponsor a hub?
Yeah, well, it needs to be strongly supported. But what we've seen also as well is having a kind of integrated project, but putting together different companies with the interest across the value chain. That make a project very robust, because when you have in the same shareholding structure both the supplier of energy, the industrial partner, and the off-taker and the final user, it makes also your project very robust. And this in turn generates an ecosystem that allows for a kind of up developments. And that's what we are seeing also quite frequently. But still, these are quite new projects, and we still need to see the economic case. I mean, that we've discussed a lot this morning. Chicken and egg problematic. So we know that, but it's coming, that's for sure.
Thank you, Henrik. Thank you, Vincent.
No, thank you very much, Aurore. That was very pleasant.
So, thank you all for your attention, and thank you.
Thank you.